Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to our inaugural podcast. My name is Justin Hand. I'm Managing Director with our firm, Provident Healthcare Partners.
I'm AJ Shekar. I'm a Vice President with Provident Healthcare Partners.
And I'm Eric Major, also a Vice President with the firm.
We have initiated this podcast, the series of podcasts, trying to educate business owners in terms of what is driving consolidation in and around the healthcare service arena. How do you think about an investment bank? What's driving the specific things within your industry? But this particular first podcast is going to be more at a high level around why is healthcare consolidating? What are the trends that are driving that consolidation? Potentially, what are the historical risks that have been a part of why consolidation is happening, and forecasting where do we think it's going, where do we think the market's going, and how do companies navigate the challenges that may exist within the industry. I'll start off by saying, as an investment bank, we are extremely optimistic about the outlook of the industry, of the market. Our focus is in around the low middle market of healthcare, and overall, we've been enormously benefited by continued interest from strategic acquirers and private equity firms that are consolidating this marketplace, which we will go into detail on future podcasts. From our perspective, healthcare continues to evolve. Challenges continue to pop up that are unexpected, but many of those challenges can be offset through strategic alignments and forward-thinking management team or business owners as they position themselves for the future. And so today, I think what we'd like to do is reflect on the history and how that's related to transactions today, and thinking about how that will move forward into the next decade or so of healthcare.
As Justin mentioned, healthcare has always been an exciting area, an attractive area for investors, as well as business owners who are seeking to create new business opportunities within the segment. I think at a very high level, healthcare is attractive because it's non-cyclical. Everyone needs healthcare services, whether it's on a routine basis like primary care checkups, or even on an acute basis if you need to be admitted to the hospital, if you have a certain injury or illness that requires additional medical attention. Within the U.S., I think as most people know, there's an aging and expanding population, which also carries over to increased demand for healthcare services overall, especially as the baby boomer generation ages. It's really putting an acute focus for most individuals on how to best position their family members, how to best position themselves, as well as the providers on how best to position providing care to those patients, especially as that pool ever increases as the population ages. And I'd say, just as a last kind of point on that, and Justin and Eric, feel free to chime in. I think it's a very wide and fragmented market. It isn't a situation like, for instance, the retail side of things, where you have large players like the Walmarts and the Targets that are the big behemoths within that industry. Instead, healthcare is very dominated by local practices, local home health agencies, local businesses. Healthcare as a whole is just very local, and you tend not to see the big 800-pound gorillas in many of the subsectors of healthcare that we see.
I think in addition to an aging demographic, I also think that the population of the United States, even from a younger generation, is changing. As more and more younger generation tends to be a little more stagnant. The rise of diabetes, heart disease, unfortunately, is impacting a younger generation as well. And strategic consolidators and private equity firms, unfortunately, but also fortunately, view that as an opportunity to, as AJ said, to consolidate an industry that's highly fragmented by also targeting disease states that are chronic in nature, and unfortunately, our disease states will likely stay with these individuals for the long term as they age.
Yeah, and I think just to reiterate Justin's point, what we're seeing across the board is just an increase in chronic conditions, no matter what the age of Americans are today. You're seeing chronic diseases which were once affecting only the senior population, really affecting people in their teens, in their childhood, in the early parts of their lives, which is really expanding the need for healthcare services across the board for all individuals these days.
Yeah, and as it relates to chronic conditions, and kind of specifically bringing it back to our role as investment bankers and the private equity investors we interact with, I think what's obviously critical about the healthcare industry is that there's going to continue to be a volume increase in demand for healthcare services going forward. Looking at CMS and their projections, I mean, year over year, the amount of money that's being spent on healthcare is increasing, and it's projected to continue to increase at an even greater pace going forward as a result of this aging population. And as we look at many of the sectors that we play in from an advisory perspective, most of them involve I would say the Medicare population, the elderly population, and the various points of care that they receive across the whole post-acute care spectrum.
Yeah, I'd say that's very indicative of our own deal flow over our firm's history. Some of the first transactions we were working on back in the late 90s were related to senior care services, whether it's home health, specialty pharmacy, infusion therapy, durable medical equipment deals. Even though there's been ups and downs in each of those sectors in terms of pace of consolidation, valuations, et cetera, those are still transactions that we work on today, which, to Eric's point, it's a natural for investors that are looking to take advantage of the positive demographic trends. But that being said, there's still risks involved in each of those segments when you have Medicare being a very big portion of that overall spend within those sectors.
Yeah, I would say while we have seen, consistent interest across many healthcare sectors, I think one of the points you make, AJ, that we don't want to glance over is that there have been, a lot of regulatory changes that have affected the M&A markets, the merger and acquisition markets in many of the industries that you mentioned, such as the post-acute care sector, such as home health and hospice. Over the years, as a result of the fact that the patient volumes have been increasing, obviously the government has been dealing with a spending issue because you have an aging population, you have people living longer. We have to figure out a way to continue to finance that and fund that going forward. So I think with that demand has come regulatory changes such as the Affordable Care Act. I think that was a big turning point. In terms of the M&A activity that we've seen since then, there's been a lot of shifting towards other areas that were affected by value-based care.
And I think the timing of the passing of the Affordable Care Act also coincided with a market rebound from a financial perspective. If people reflect back on the Great Recession of 2008 to 2010, the Affordable Care Act passed right around the back end of that. And so what we've seen, and a big driver of consolidation in the marketplace, is the fact that more publicly traded companies had cash to spend, but at the same time, more and more private equity firms are raising capital and then trying to find areas of healthcare that could benefit from consolidation. And now business owners, or in our opinion, now business owners that were now tasked with having to monitor their business in a different way from a technological standpoint, as they had to fear the evolution moving towards value-based medicine and being penalized to the extent that they don't have the outcomes that are expected or mandated by Medicare or the federal government. Now they're thinking about their solutions for their business models, and quite honestly, the solutions for their income stream, and private equity and strategic acquirers have presented themselves as an opportunity. So I think the capital markets, the opportunity for consolidation, which is really the root of what we're purpose of this podcast, is now there is a solution for business owners that saw the regulatory markets change, saw how that impacted their business in the short term, but in all reality, how that's really going to impact their business for the long term. Healthcare will continue to change on a regular basis. Reimbursement will continue to change on a regular basis dependent on the specialization of your organization. What's common across all healthcare providers, regardless of what your background is, and those attendees listening to this, is that you have risks unlike other businesses, and you are all sharing those similar risks. And so financial engineers are trying to find a way to bring organizations together because in their mind, and quite honestly in most business owners' mind, being bigger gives organizations more power to deal with the changes that are likely to continue to come.
Yeah, and I think, when we talk about being bigger, the question is bigger better? And
at what expense?
And I think in healthcare, it's clear there's a lot of inefficiencies, in being in the healthcare industry now for 6 years, you recognize that the way things are managed and the way that the government reimburses or used to reimburse organizations on a fee-for-service basis creates misalignment of incentives. So I think private equity has a strong role in this industry because through consolidation, businesses are able to operate in a much more efficient manner from a business perspective, and ultimately that does lead to better patient care, better investment into IT systems, which are critical now when you look at capturing outcomes and making sure that you're reporting quality metrics to CMS. That's been a big shift in the industry as a result of private equity.
Yeah, and I think what you mentioned, Eric, in terms of the healthcare IT spend and data capture is really a big reason as to why the post-ACA consolidation spree has really been different than what we saw in the late 90s with the rise of the public physician practice management groups. I think at that point it was less alignment of incentives because groups were simply aggregating to create efficiencies in the back office without really creating shared incentives between providers, payers, and management teams of these groups. I think at the same time, they probably didn't have the same, or they definitely didn't have the same data capture abilities to actually take value-based, evidence-driven data points to the payers and really create value in terms of these changing reimbursement models. And I think that those lessons learned from that saga of the publicly traded companies has really allowed groups to tweak their models in order to create a more lasting structure of business operations in this new consolidation era.
And quite honestly, those investments in these businesses are just going to continue for the future. So the EHR, or the financial systems that are instituted today to manage the current situation around reimbursement, are going to have to be continued and invested into. And so a lot of organizations don't like the fact that margins in the businesses potentially are going to erode in the future. Those investments continue to have to be implemented into the organization. I think another, maybe more in particular on the physician side, and correct me if you disagree with this, but I think that a lot of recent grads of fellowships or residency programs have an interest in aligning with organizations that have prepared themselves for the future, have invested in the infrastructure to support themselves. So I think it also, those organizations that have good systems in place make it easier to recruit the best caliber physicians in the case of on the physician side, or on the post-acute side in home health or hospice, those that are working off of technology-based services, iPads when they go into the home of a patient. That's where the younger generation chooses to work these days. So I think from a recruiting perspective, it also is intertwined with technology and the investments that are necessary of these businesses to maintain their market dominance in their industry.
Yep. I'd say for private independent organizations, some of those investments can really be hard to stomach for business owners because it's a direct reduction in their income to support those investments. And yes, you could go to a bank, but they have personal guarantees attached to those sorts of financing sources. How sustainable is it to continue borrowing from your local bank if you're trying to implement systems on a $20 million, $30 million revenue business? I think for a lot of operators out there and a lot of healthcare entrepreneurs, it becomes a point where they decide, do I need to mitigate my risk in the face of such rapidly changing requirements from a technology perspective, while reimbursement is changing fundamentally how I earn my living at the end of the day also.
I'd say beyond the technology that is demanded as a result of value-based care and the transition of the ACA, it's also becoming more and more difficult to recruit the right business folks as well that understand MIPS and MACRA and some of the reimbursement changes and reporting needs that you have now as physician groups or other organizations across the healthcare spectrum.
I think these are all realistic risks that are factors in terms of why consolidation is happening. But I think at the end of the day, one of the other biggest reasons is that valuations are at their all-time high. And we've seen more flexibility around structure. We see organizations that historically didn't have an option to align with the private equity organization, and their option was simply to sell to a strategic or sell to a health system, or if it's a physician group, and someone's retiring, they sell their equity to the youngest generation in the business, and maybe they keep their AR, or they likely keep their AR. The value of their hard work wasn't recognized. But over the last decade, but more so I'd say over the last 7 or 8 years, what we've really seen is a big push from the private equity community investing into these businesses and valuing them in a way that have historically never been valued. So I think fundamentally economics, or the reality of how these deals are being valued today, is driving much of the consolidation out there where it didn't exist in years past. So I don't think we can lose sight of, it's not just around risks, it's not just around fears of healthcare. I think it's around the reality of there's real wealth opportunities here for business owners that may have been more difficult to do 10 years ago. And those that did it 10 years ago certainly weren't getting the valuations that we're able to achieve today in these processes.
Exactly. There's so many positive growth dynamics that even arise out of the ACA in terms of, Medicaid expansion in certain states. There's increased insurance enrollment, a premium being placed on identifying, preventative services that can catch some of these disease states earlier on, creating efficiencies within the healthcare system that allow patients to access care in a much more convenient way than just simply going to a hospital system, which we've seen create increases in areas like ASCs, urgent cares, retail healthcare overall, which companies that have that platform in place to address these tenets of providing access to care in a more efficient and cheap manner are really the ones who, in my opinion, are going to best benefit from some of these forward-looking, projections that the ACA is creating at the end of the day.
I think projections is a really critical word there. Healthcare is here to stay. Healthcare is going to continue to grow. Healthcare, unless some major reform happens, is going to continue to increase as a percentage of the GDP of this country. And so what the markets are trying to do is find efficiencies in the business model in some way. At the end of the day, you can never lose sight of the fact that either Eric or AJ commented on this earlier. Healthcare is localized. That has to stay the same. But there is efficiencies in size and scale, and that is ultimately what organizations are hoping to achieve as they think about consolidating a particular industry.
Yeah, and I think as healthcare investment has evolved over the years, we've seen a lot of industries that were a little bit under the radar in terms of a target for investors many years ago that are now becoming areas of heavy consolidation activity. We talked a lot about we've mentioned physician groups a number of times on this podcast, and I think that's been a big area of focus for investors over the last decade is transitioning their strategies into growing physician groups, providing practice management services to small organizations that really don't have great infrastructure, that don't have a management team in place, and many areas that back in the 2000s, early 2000s that had never seen consolidation from private equity have started to see a lot more activity, and that's created more deal flow for private equity firms. It's also opened the eyes up to physician owners that maybe didn't realize that private equity could be an option for their organization.
That's a good point. It totally changed the profile of a typical client of our business, where it used to be organizations that were closer to retirement and this was their exit. Now it's business owners that believe in their business model but want the support of someone else or some other team that can stand behind them as they think about it, growing the organization and taking it to the next level. Quite honestly, it's a really good thing for all business owners out there. What's happened is the opportunities for your businesses expand exponentially over the last few years compared to years back.
Yeah, I think that's part and parcel of the valuation side of things as
Sure.
well. When you have only a few number of really quality platforms and a number of these subspecialties of healthcare, but all these various consolidators chasing the sector, whether it's private equity, whether it's strategic groups with private equity backing, hospitals, payers. It's simple kind of economics 101. The more demand there is, the greater the value of the supply, which in this case would be organizations that are thinking about consolidation today. And certainly that is different from subsector to subsector of healthcare. And I think we can spend a lot of time in future episodes talking about what's happening within each subvertical of healthcare services. But I think to Eric's point earlier, it is a constantly evolving landscape in terms of where groups are looking to place their investments into from a healthcare perspective, which has really made kind of opened our eyes in the last few years as to what value there is to be created from private equity and some of these sources in healthcare today.
Yeah, I think as we think about the future of healthcare, there's obviously that regulatory backdrop and the risk that providers have in terms of the stroke or the pen risk. There can be major changes to the healthcare system and the revenue of groups, as a result of, changes made from a federal perspective. And I think going forward, many organizations, are concerned about, as a result of the new administration, how does that, affect this whole ACA and the transition to value-based care? And I think from my perspective, and you guys feel free to chime in, but from what we've been hearing, obviously the investment in value-based care has happened. Payers have made those investments over the years. CMS has invested heavily into it. I think there's a lot of value to moving towards a system that's based on quality, not just fee for service and quantity. So I wouldn't expect that's going to change going forward. Despite any changes from the administration, I think value-based care is here to stay. And I don't know if you disagree.
Yes, I totally agree with you. I think it's here to stay. I think it's a good thing for the system as we're all burdened by the cost of healthcare in this country, be it through private insurance or taxes paying for Medicaid and Medicare. I think the only thing, in addition to the new administration, I think you face that with the next administration that comes in and the next one. I think that's the reality of healthcare is anytime someone else is reimbursing for your services, there's risk of who's sitting there at the table and making a decision of how things are reimbursed or how things are reimbursed and paid. So I don't think that's not a change that goes away with whoever's in administration in the future.
I'd say from an M&A standpoint, I think all the reasons mentioned previously are really leading to an environment where valuations are very high. I think a common question we get is where we see things going in the future, just as there's uncertainty from a regulatory perspective and how that will affect healthcare in this administration and subsequent administrations. What we're seeing now is that there's a great economic backdrop to M&A within healthcare services. The public markets are doing well. Debt is still relatively cheap to finance these transactions. I think we've seen increases in interest rates in the short term. Tough to say how much higher those go in the future, but I think that being said, it's a critical piece of understanding the M&A landscape today and knowing that a lot of groups are taking advantage of some of the favorable market dynamics we're seeing, while still, leaving question marks as far as what's happening in the future, which is why we're seeing, transaction volumes and transaction dollars as high as they are today in comparison with previous years.
Yeah, timing is always the big question, that the groups have is what is the right time, in relation to, the regulatory changes in healthcare in relation to, the global M&A markets. And, obviously there's a lot of uncertainty. I think that's the certainty is that we can't predict the future. But, I think from a valuation perspective, there's a reason why there's been so much healthcare transaction volume in the last few years. And I think from our firm's perspective, there's a reason why we've had such strong deal flow the last few years. It's a direct result of the very strong M&A markets, specific to healthcare and from a global perspective.
Yeah, in summary, I think we find ourselves in an environment where there's a lot of risk as created by regulation, changing payer models, and just overall sentiment within the industry, but there's also a lot of opportunities that are propelling future growth, which has really kept us optimistic about the healthcare M&A landscape today. In future episodes, we're going to spend more time on what the potential opportunities are out there for healthcare entrepreneurs and shareholders. But in the meanwhile, we thank you for your time in listening to this podcast. This is AJ Shekar.
This is Justin Hansen.
And this is Eric Major. Thank you all for joining.